Most dropshippers think they don't have to worry about sales tax, and that belief is exactly what gets them hit with a bill they never saw coming. Here's the reality. Sales tax is a state issue, not a federal one. That means every single state gets to make their own rules about who has to collect it, when they have to collect it, and what happens when you don't. And the tricky part for dropshippers specifically, you don't have a physical store. So you might be sitting in one state and your supplier is in another state, and your customer is in a completely different state. So whose rules apply? That's exactly what we're going to break down today. By the end of this video, you'll know whether you have to collect sales tax, which states are most likely to come after you, and what you need to do right now to protect yourself. By the way, my name is Kiera. I'm an enrolled agent and I specialize in sales tax compliance for e-commerce businesses. I've spent years helping online sellers clean up exactly the kind of mess we're talking about today. So trust me when I tell you, you want to know this stuff before the state figures you out. The whole conversation starts with one word, nexus. Nexus is just a legal term that means you have significant enough connection to a state, and that state can require you to collect sales tax from customers there. There are two types. You need to understand both. The first is physical nexus. This is the old school version. If you have physical presence in a state, an office, a warehouse, employees, you have nexus there. Simple. But here's where dropshippers get caught. If your supplier stores inventory in a state before shipping it out to your customer, that inventory can create physical nexus for you in that state, even if you've never stepped foot there, even if you had no idea your supplier was operating out of a warehouse in Ohio. The second type is economic nexus, and this one changed everything. Back in 2008, the Supreme Court ruled a case called South Dakota versus Wayfair. Before that ruling, you generally only had to collect sales tax where you had a physical presence. After Wayfair, states could now require you to collect sales tax based purely on how much you sell into that state. Today, almost every state in the country has an economic nexus threshold. The most common one is 100K in sales or 200 transactions in a state in 1 year. Once you cross that line in a state, you are required to register, collect, and remit sales tax there. So if you're doing volume, if your store is actually moving product, you are almost certainly already past the threshold in multiple states and you may not even know it. Now, let's talk about the part that makes dropshipping specifically complicated. In a traditional retail model, there's only one seller and one buyer. Sales tax is straightforward. In dropshipping, there are three parties: you as the retailer, your supplier, and your customer. When your supplier ships directly to your customer, a sale technically happens twice. Once the supplier sells to you and once you sell to your customer. Here's the thing most people don't know. As the retailer in this transaction, you are the one responsible for collecting sales tax from your end customer, not your supplier. Your supplier should not be charging sales tax on the goods that you're reselling. That's what the resale certificate is for. A resale certificate is a document that you give to your supplier saying, I'm buying this to resell it. Therefore, do not charge me sales tax. If you don't have a resale certificate on file with your suppliers, you may be paying sales tax and you don't actually owe. On the flip side, if you're making sales into states where you have nexus, you are supposed to be collecting sales tax from your customers and sending it to the state, not keeping it, sending it. This is where the exposure comes from. Dropshippers who don't know the rules either overpay their suppliers or undercollect from customers. Both are expensive mistakes. Not every state enforces sales tax in the same way. Some states have limited resources and minimal audit activity. Others are known for being aggressive and showing up for even smaller sellers. A few states that consistently come up in sales tax enforcement and audit activity are California, large economy, dedicated sales tax enforcement division, and they'll go after e-commerce sellers regularly. If you have any volume into California, you want to be compliant. New York, similar story. New York has a detailed audit process and they look at online sellers specifically. Texas has no income tax, which means they rely heavily on sales tax revenue. They are motivated to collect and they have the resources to do it. Washington State, one of their earlier states to push for online seller compliance and still very active. Pennsylvania and Ohio round out the list as states that have been increasingly focused on remote seller audits. This is not a complete list. Any state with significant revenue from sales tax is going to protect that revenue. But these are just the ones that consistently show up when you talk to people who have been through a state sales tax audit. Okay, so what do you actually do with all of this? Step 1, figure out where you have nexus right now, today. Pull your sales data by state. If you're on Shopify, this is built into your reports. Look at which states you've crossed $100,000 revenue or 200 transactions threshold in. That's your nexus list. Step 2, get resale certificates on file with every supplier you work with. This protects you from being charged sales tax on inventory you're reselling. Suppliers should have a form for this. If they don't know what a resale certificate is, that's a problem worth addressing. Step 3. Register in the states where you have nexus. You cannot legally collect sales tax until you are registered to do so. Going to each state's Department of Revenue website and registering is not optional once you cross the threshold. It's the law. Step 4. Set up sales tax collection in your store. If you're on Shopify, there's a built-in sales tax settings section. You'll configure it to collect sales tax from customers in the states where you're registered. Step 5. File and remit on time. Once you're registered, states will assign you a filing frequency, monthly, quarterly, or annually, depending on your volume. Missing a filing creates penalties and interest that add up quickly. Now, if this sounds like a lot to untangle on your own, it can be, especially if you've been selling for a while and haven't been collecting. The situation has a name. It's called a Voluntary Disclosure Agreement, or a VDA, and it's actually a pathway to getting compliant without facing the full penalty exposure of the state audit. But that's a separate video. Here's what you take away from this today. Dropshipping does not protect you from sales tax. Economic nexus means once you hit the threshold in a state, you owe, regardless of where you or your supplier are located. The fix is knowing where you have nexus, getting registered, setting up collection before a state finds you first. If you want to know exactly which states have the lowest threshold and the most aggressive enforcement, I put together a free document that breaks it down. The link is in the description, grab it. If you're watching this thinking, I've been selling for 2 years and never collected a dime in sales tax, don't panic. These are the options. Drop a comment below, check the description for how to book a consultation. This is fixable. Subscribe if you want to keep learning how to protect your money. New videos every week.